So let's turn our attention to Berkshire Hathaway, taking it on the proverbial chin today. Warren Buffett's company posting a 77% drop in Q3 earnings. Net income hitting $1.06 billion. That's $682 per Class A share. So far for the year, take a look. The stock down more than 20%. The question we need to be asking, does this news mean, what does it mean for investors? And actually, what does it mean to the markets overall? Harry Clark is founder and president and CEO of Clark Capital Management Group. Greg Womack, president of Womack Advisors, an avid tracker of some big names, Bill Gates, Boone Pickens, and most importantly, Warren Buffett. Greg, I want to start with you. I mean, I know that we thought he got some good deals out of GE and Goldman Sachs. Dare I say, I mean, is the Buffett model, if it's not broken, is it bent?
Well, we are in a tough economy, and it's something we haven't seen in some time. And I think what we're seeing with Berkshire is, you know, they're tightening the screws. A lot of companies are having to do this. And so I don't think it's the end of the model by any means. We've got a great leader at the helm of Berkshire Hathaway, and he's taking steps and leading the way in the market of picking up some great values during this time. But, you know, the market is tough. I mean, the hurricanes hurt the insurance side of the business, and they have some, you know, unrelated or unrealized derivative losses. So, you know, this is a tough economy, and even our best companies like Berkshire Hathaway are experiencing some tough times.
And Greg, isn't this the Berkshire Hathaway model, the Buffett model in action? I mean, he takes some hits. He was able to take some hits. He's buying things now, and we're looking at the company here on a quarter-to-quarter basis, which that's not really the way to look at Berkshire Hathaway, is it?
No, it's not. You know, Warren Buffett is known to say that you want to be fearful when others are greedy, and of course greedy when others are fearful. And we've had, what have we had lots of lately? Lots of fear. Volatility index has been extremely high. It's come down from the highs, but, you know, so Warren has been out leading the charge of investing in companies. You know, he's thrown some money at GE, about $3 billion.
Hey, Greg. Yeah. I'm sorry to interrupt because we want to bring in Harry, and of course we want to work in the whole conversation. Quickly, can you just tell us if people do believe in the model, and you can give a quick synopsis of that model, but how can actually investors who can't afford $113 for a share, how do they get involved in that model?
Well, you take a look at what Berkshire Hathaway is owning, and what they're owning are consumer staples, consumer goods, about 38% of the portfolio, and financial services. So instead of going out, if you can't put a lot of money into an individual company, you want to look at some ETFs perhaps that have exposure to some good consumer goods. For example, XLP is the Spider Index. Its top holdings are Procter & Gamble, Walmart, Philip Morris, Coca-Cola. Those are companies that Warren Buffett invests in, those type of companies. And they pay a good dividend.
Harry Clark, we ended this week higher after a big sell-off the last couple of days. Does that say anything that we ended this market? People are going into the weekend a little longer than they were on Wednesday and Thursday. Is that good?
I think it's a very good sign, Scott. You know, the 1,000-point decline we had, I think, was a knee-jerk reaction. I think people settled down late yesterday and today and thought this over. Why are we doing this? Things aren't that bad. We got a new president. We're going to be behind him. I already think he's moved to the center. Look who he has for chief of staff, a very centrist-oriented person, Ron Emanuel. I think a lot of fear is going to be out of the markets. It's interesting. When the president-elect was talking today, the market started to sell off. When he stopped talking, they thought, oh, what's this guy saying? They really liked it. And went right back up again when he stopped talking. So Harry, he had a good press conference today.
Harry, you think people are more encouraged about President-elect Obama than they are worried about the jobs numbers that came out today?
I think they are. I think the jobs numbers are going to hit a bottom here pretty soon. You know, typically they go up. I think 7.5%, 7.75% might do it. I don't think 8% is going to happen this time around. So we'll be out at the bottom of the employment market in a few more months. But I think they liked what the guy had to say, and the numbers are almost old hat anymore. They could have been worse. They were looking for worse, didn't get it. So people were encouraged by what he said. He said one thing about his economic policy. He's going to wait for more data to make some more decisions. That was a very important comment.
Was it just what he said, Harry, or was it also the people who were there with him? Because I have this impression that the confidence comes from those people who were there, and I think people see Paul Volcker, they see Rubin, and they know Warren Buffett.
That was a very smart move on his part. Very smart move.
We've had this huge cross current, just to want to get this in, of hedge fund redemptions, hedge funds building up cash to go into these redemptions, which we got another week or so till the deadline. Does an up close today mean that we're past that, or are we going to have some rough waters in the next week?
You know, we're in the process of making a bottom. We're not past it yet. The bottom in 02 and 03 took 6 months. This will take 6 months, I believe, maybe a little bit less, a little bit more. But there's so much cash out there. If you look back at the cash ratios, we have more cash now than we've had in the last 30 years. Last time we had this, the market doubled the next 2 years. So there's some good potential out there.